Disclaimer.
I'm AG. Just 5 days ago, silver hit $86. Everyone saw the headlines, but I was looking at COMEX delivery data that told a completely different story. What happens this week isn't just market volatility, it's a stress test our precious metal system was never designed to survive. Last Monday, December 30th, while most of America was planning New Year's celebrations, silver quietly did something it hadn't done in modern market history. It hit $80.62 per ounce, smashing through every resistance level that technical analysts had marked as impossible to break. But here's what should grab our attention. This was not your typical bull run driven by Reddit traders or retail investment mania. Something far more urgent was happening in the shadows of our financial system, and the evidence points to institutional panic that most investors completely missed. Think about how markets normally work when prices spike. You see gradual buying pressure building over days or weeks, social media buzzing with excitement, retail brokers reporting surges in account openings. None of that happened before December 30th. Instead, what we witnessed throughout December was a delivery surge that caught the entire system off guard. Over 60% of COMEX's registered silver inventory was claimed for physical delivery in just the first 4 trading days of the month, representing an unprecedented drain that market analysts are calling a vault emergency. When traders demand physical delivery instead of just settling contracts in cash, they're essentially saying, we don't trust the paper price anymore. Give us the actual metal. And when that number reaches levels we haven't seen in modern market history, someone knows something the rest of us don't. Here's where it gets interesting. This wasn't retail investors or small speculators driving these delivery demands. According to COMEX warehouse reports, the major players taking physical delivery were the same bullion banks that have spent decades managing silver derivatives and maintaining orderly markets. Institutions like Deutsche Bank, RBC, and JP Morgan. These are the sophisticated players who wrote the rulebook on precious metals trading, and they were suddenly competing for physical metal in quantities that raised alarm bells across the industry. When the insiders who typically maintain market stability start acting like there's a shortage, that's when you know something fundamental is shifting. Now, pop quiz. What happens when you combine that kind of institutional stress with the largest forced liquidation event in the silver market since 1980? Because that's exactly what's about to hit our market starting January 9th, and the timing couldn't be more critical given what just happened on December 30th. The Bloomberg Commodities Index is about to begin its mandatory 5-day rebalancing process, and here's why that matters to anyone holding silver investments or watching precious metals. Index funds tracking this benchmark don't have a choice. They must sell positions to rebalance their allocations according to predetermined formulas. The calculations from Bloomberg's published methodology show these passive funds will need to dump approximately $5 billion worth of silver futures contracts, representing roughly 13% of total open interest in the silver market. To understand that scale, imagine if 13% of all stock market participants were forced by mathematical rules to sell their positions within 5 trading days, regardless of price, demand, or market conditions. That's the kind of selling pressure we're looking at. But here's what makes this moment unprecedented, rather than just another routine rebalancing. This isn't happening in a calm, liquid market with plenty of willing buyers waiting to absorb that supply. According to COMEX warehouse data published on January 2nd, registered inventory, the silver actually available for immediate delivery, sits at just 31.8 million ounces. Meanwhile, outstanding paper claims on that silver represent approximately 800 million ounces. That's a leverage ratio of 25.1. Meaning 25 different contracts are claiming ownership of the same physical ounce of silver. If you think that sounds familiar, you're right. That's a higher leverage ratio than the mortgage-backed securities that triggered the 2008 financial crisis, where leverage ratios of 15:1 and 20:1 were considered dangerously reckless. Let's break down what this actually means for the real economy and our financial system. Every silver contract traded on COMEX represents 5,000 ounces, and for decades, roughly 95 to 97% of these contracts settled in cash rather than physical delivery. That system worked beautifully when everyone trusted the paper price and nobody questioned whether the metal actually existed in sufficient quantities. But December 30th's delivery surge suggests that trust is evaporating, and when trust disappears in leveraged markets, the mathematics become brutal very quickly. Think about your own investment portfolio for a moment. If you own silver ETFs, mining stocks, or futures contracts, you are participating in a market structure where the price discovery mechanism depends on this 25:1 paper-to-physical ratio remaining stable and unchallenged. The problem is that price discovery only works when the paper contracts remain theoretical, when they are just financial instruments that people trade back and forth without ever demanding the underlying asset. The moment significant numbers of contract holders start standing for delivery, the entire structure faces a test it wasn't designed to pass. Here's the uncomfortable truth that Wall Street doesn't advertise in their silver marketing materials. Our modern precious metals market operates on the assumption that physical scarcity does not matter as long as financial liquidity remains abundant. Banks and market makers maintain orderly price action by creating unlimited paper contracts, confident that demand for actual delivery will stay minimal and predictable. This system has worked for 40 years because it served everyone's interests. Miners got stable prices for production planning, industrial users got reliable supply for manufacturing, and speculators got liquid markets for trading. But what happens when the fundamental assumption breaks down? What happens when the leverage ratio that everyone ignored suddenly becomes the most important number in the market? The data from late December shows us exactly what happens. Banks scramble to secure emergency liquidity, market makers widen bid-ask spreads, and somewhere in the background, institutional players who understand market structure start positioning for a scenario that most retail investors haven't even considered as possible. Now let's add one more variable to this equation that makes the timing particularly crucial. The $5 billion forced selling from index rebalancing isn't happening in isolation. It's hitting a market where physical inventories are already stretched thin, where December's delivery demands already exposed cracks in the system, and where the mathematical relationship between paper claims and physical metal has reached ratios that would alarm any risk manager examining the structure objectively. We're not talking about a potential problem that might develop over months or years. We're watching a liquidity crisis unfold in real time, with the next critical phase beginning in just days. Well, what's fascinating about this situation is that the warning signs have been visible for anyone willing to look at the actual data, rather than just price charts. COMEX registered inventory has been declining steadily for 18 months, dropping from over 90 million ounces in mid-2023 to the current 31.8 million. During that same period, open interest, the number of outstanding contracts, has remained elevated, meaning the leverage ratio has been quietly climbing while most analysts focused on whether silver would break through 30 per ounce. December 30th was not random technical breakout. It was the market finally acknowledging what the inventory data had been screaming for over a year. So here's where we stand as we head into the most critical week for silver markets in decades. We have a physical shortage, developing in registered inventories, a leverage ratio that would terrify banking regulators if they applied the same standards they use for other markets, forced selling from index funds that must liquidate regardless of market conditions, and evidence from December 30th that sophisticated players are already scrambling to secure physical metal outside normal market channels. Each of these factors alone would create significant market stress. Together, they're setting up a scenario where the paper price and physical reality could diverge in ways we haven't seen since the Hunt brothers tried to corner the market in 1980. The question isn't whether this rebalancing will create volatility, that's mathematically certain. The real question is what happens when $5 billion in forced selling hits a market that is already showing signs of physical shortage, and whether our current market structure can handle that stress without something fundamental breaking. Because if December 30th taught us anything, it's that when the paper market loses its grip on reality, the institutions maintaining that system will do whatever it takes to keep it functioning, even if that means emergency Fed operations in the billions. And that was before the largest forced liquidation in 40 years was about to begin. Now, here's where the story gets really interesting, because while American investors were watching silver's price action on their screens, 3 separate developments were quietly unfolding across the globe that revealed just how disconnected our paper markets have become from physical reality. And the institutions that understand this disconnect are not just watching. They're betting billions that most investors won't figure it out until it's too late. Let's start with something that hasn't happened in 50 years. Russia's central bank, according to official documents filed with the Bank of Russia in November 2024, became the first major central bank in half a century to officially add silver to its state reserves. We're not talking about a token gesture here. This is a $535 million allocation program running through 2027, with monthly purchasing quotas that dwarf what most institutional buyers accumulate in a year. Think about what that decision signals. Central banks are notoriously conservative institutions that move at glacial pace and only act when they are absolutely certain about long-term strategic value. They don't wake up one morning and decide to add a new asset class to national reserves on a whim. But Russia's move tells us something even more important than just one country's resource strategy. For 50 years, silver has been treated as an industrial commodity by central banks, something for manufacturers and electronics companies to worry about, not a monetary asset worth holding alongside gold and foreign currency reserves. That consensus just shattered. And when you see a major power break from 5 decades of established policy, you have to ask what analysis led them to that conclusion. What do Russian strategists see in silver's fundamentals that convinced them to commit over $500 million to accumulating a metal that Western central banks have ignored for generations? The answer becomes clearer when you look at what's happening in China's physical silver markets. Shanghai Silver Exchange premiums, the extra amount buyers pay above the official COMEX spot price to actually get metal delivered in China, hit 8 per ounce in late December with some trading days, seeing the physical market surge to $80, while COMEX struggled at $72. Let me put that in context. When premiums reach 3 or 5 above spot, traders call it a supply crunch. When they hit $8 and persist for weeks, institutional buyers start getting genuinely nervous. That's not some temporary glitch or local shortage. That's the market screaming that physical silver in Asia is worth dramatically more than the price being quoted on our futures exchanges. Here's what that premium structure reveals about the real state of global silver markets. Sophisticated institutional players are running geographic arbitrage operations, buying paper contracts in New York at COMEX prices and immediately selling physical metal in Shanghai at massive premiums. According to Bank for International Settlements data on precious metals flows, this arbitrage volume has increased 340% since August 2024. When arbitrage opportunities of that magnitude persist for months, instead of getting eliminated in days or weeks, it means the price disconnect isn't temporary, it's structural. The paper price in New York and the physical price in Shanghai are telling completely different stories about supply and demand, and that divergence is exactly what happens when paper markets lose their ability to reflect physical reality. Now, let's talk about what industrial buyers are doing, because their behavior reveals just how serious the supply situation has become. Major manufacturers in the electric vehicle and electronics sectors are scrambling to secure silver supply in ways that break from decades of established purchasing practices. According to industry reports, EV producers are facing a critical challenge. Each electric vehicle uses approximately 25-50 grams of silver, roughly double what traditional cars require. And with global EV production projected to hit 17 million units in 2025, that's creating unprecedented industrial demand that simply wasn't factored into supply planning even 2 years ago. What makes this particularly telling is how manufacturers are responding to supply constraints. Instead of the usual approach of slowing purchases when prices spike and waiting for markets to stabilize, we're seeing companies lock in long-term supply agreements and pay significant premiums above spot prices just to guarantee they'll have metal when production lines need it. Even Tesla CEO Elon Musk publicly warned about China's upcoming silver export restrictions on January 1st, stating bluntly that silver is needed in many industrial processes, and the restrictions were not good. A rare acknowledgement from a CEO known for downplaying supply chain concerns. When the world's leading EV manufacturer is openly worried about silver availability, that tells you the shortage isn't theoretical anymore. It's showing up in actual production planning. What makes these industrial buying patterns so revealing is the contrast with how manufacturers normally behave. In typical commodity markets, when prices spike, industrial users slow their purchasing, draw down existing inventories, and wait for prices to stabilize before resuming normal buying patterns. But in silver right now, we're seeing the exact opposite, accelerating purchases despite record high prices, companies competing for long-term supply contracts, and a complete abandonment of the do you wait and see approach that usually characterizes industrial procurement during price spikes. You only see that behavior when buyers have run the analysis and concluded that securing supply at elevated prices today beats the risk of not having metal available when production lines desperately need it tomorrow. So what's driving this supply panic among the world's largest industrial consumers? The numbers from the Silver Institute's 2025 World Silver Survey paint a picture that most investors haven't fully grasped. Silver is facing its 5th consecutive year of supply deficit, with 2025's shortfall reaching 215 million ounces, meaning demand exceeded new supply by roughly 7% of total above-ground stocks. But here's the part that makes this deficit fundamentally different from typical commodity shortages. Approximately 70% of silver mine production comes as a byproduct of copper, zinc, and lead mining operations. Let me explain why that byproduct dependence matters so much for supply dynamics. When copper prices are high, mining companies produce more copper, and silver comes along as a secondary output whether they want it or not. When copper prices fall, they cut production and silver supply drops accordingly. This means silver supply cannot respond directly to silver price signals the way most commodity markets work. If wheat prices double, farmers plant more wheat. If oil prices spike, producers drill more wells. But if silver prices triple, primary silver mines, which only represent 30% of supply, can increase output slightly, while the 70% of supply that comes from base metal operations continues following whatever copper and zinc markets are doing. Think about what this creates from an economic perspective. We're experiencing the largest industrial demand surge for silver in 40 years, driven by 3 simultaneous megatrends: solar panel production requiring roughly 140 million ounces annually, electric vehicle manufacturing consuming another 90 million ounces, and the AI infrastructure build-out demanding silver for servers, data centers, and advanced chip manufacturing. But the supply side of the equation can't respond to these demand pressures because it's fundamentally tied to different commodity markets that have nothing to do with solar, EVs, or AI. This creates what economists call an inelastic supply curve. And when you combine that with surging demand, you get price dynamics that don't follow normal patterns. In typical markets, high prices eventually bring new supply online, which moderates prices and creates equilibrium. But in silver, we're looking at a structural deficit that mining economics suggests cannot be resolved through price signals alone. Even if silver hit $150 per ounce tomorrow, you can't just open new primary silver mines overnight. That takes 5 to 7 years of exploration, permitting, and development. And the base metal mines that produce 70% of supply are making production decisions based on copper and zinc prices, not silver. The implications of this supply structure become even more critical when you consider the inventory dynamics we discussed earlier. If COMEX registered inventory is at 31.8 million ounces, and we're running a 215 million ounce annual deficit, that means the entire available delivery stock represents less than 2 months of the current supply shortfall. In a functioning market with elastic supply, that would be concerning but manageable. But when supply cannot respond to price increases, and when demand is being driven by industrial requirements that companies literally cannot avoid if they want to stay in business, you're looking at a mathematical equation that doesn't have a market-based solution. Here's what all of this evidence adds up to. The paper markets, where most investors trade silver, are pricing the metal based on derivatives, leverage, and financial flows that have become increasingly detached from the physical fundamentals. Meanwhile, central banks are accumulating for the first time in 50 years. Physical premiums in Asia have exploded to 29% above paper prices, and the world's largest manufacturers are paying massive premiums for future supply because they've concluded that production halts represent existential threats to their operations. These aren't random developments. They're all pieces of the same puzzle, showing us that the divergence between paper and physical markets has reached a critical inflection point. The fascinating part is that Wall Street analysis largely ignores these supply-side realities. Most research reports focus on technical patterns, fund flows, and sentiment indicators, while treating physical supply as a minor detail that sorts itself out automatically. But when you're looking at structural deficits that cannot be resolved through normal market mechanisms, when you're seeing geographic price discrepancies that persist for months instead of days, and when you're watching industrial buyers abandon decades of established purchasing practices, those are the signals that matter far more than whatever the latest Commitment of Traders report shows about speculative positioning. What we're witnessing is not just another commodity cycle, where high prices eventually bring supply and demand back into balance. We're watching the early stages of a supply crisis unfolding in real time, where the mathematical reality of 215 million ounce deficits meets the financial reality of 800 million ounces in paper claims, chasing 31.8 million ounces of deliverable metal. And the players who understand this disconnect? The Russian central bank accumulating silver for the first time in 50 years, Chinese physical buyers paying $8 premiums, and major EV manufacturers breaking normal procurement protocols are not waiting for the rest of the market to figure it out. They're positioning now, paying premiums that look irrational on paper, but make perfect sense if you believe the current market structure is fundamentally unsustainable. Now let's talk about the mathematics that make this week's rebalancing event completely different from anything we've seen before in precious metals markets. Because when you run the actual numbers on what's about to happen between January 9th and 14th, you start to realize this is not a question of whether there will be market stress. It's a question of how severe that stress becomes and whether our current market structure can handle it without something breaking. Here's the calculation that should keep every silver investor awake at night. The Bloomberg Commodities Index rebalancing requires passive funds to sell approximately 160 million ounces worth of paper silver contracts to bring their allocations from the current 9% weighting down to the target 4%. That's the selling pressure, forced, non-discretionary, and happening regardless of price or market conditions. Now, let's look at the other side of that equation. COMEX registered inventory sits at 31.8 million ounces of actual deliverable metal. Stop and think about that ratio for a moment. You have forced selling of 160 million ounces of paper claims, hitting a market where only 31.8 million ounces of physical metal is available to settle those contracts if anyone demands delivery. What happens when that much selling pressure meets that little available supply? In a normal functioning market with elastic supply, prices would drop temporarily as sellers outnumber buyers. But eventually, new supply would emerge at lower prices and equilibrium would restore itself. But this isn't a normal market situation. We're not talking about a commodity where lower prices bring more supply online quickly. We're talking about a market that's already running a 215 million ounce annual deficit, where registered inventories have been declining for 18 months, and where physical premiums in Asia are telling us the real supply situation is far tighter than paper prices suggest. Think about what this means for market mechanics during the rebalancing week. Market makers, the firms that provide liquidity by constantly offering to buy and sell contracts, are going to see this tsunami of forced selling coming, and they are going to do what any rational market participant would do. They are going to step back. According to TD Securities analysis, we could see bid-ask spreads, the difference between what buyers are willing to pay and what sellers are asking, explode from the normal 0.30 to potentially 8 to a 12 per ounce, as liquidity providers withdraw from the market rather than take the risk of being on the wrong side of this forced liquidation. When spreads widen to those levels, it means the market has essentially stopped functioning as an efficient price discovery mechanism. So what does this actually look like in practice? Here's the scenario that commodity strategists are quietly preparing for. Spot silver could drop sharply during the rebalancing period, potentially testing the 62-65 range as paper contracts get dumped into a market with reduced liquidity. But here's where it gets fascinating. While the paper price is falling, physical premiums could simultaneously explode to 30 or more above spot, as anyone who actually needs metal discovers that COMEX prices no longer reflect the cost of securing actual delivery. You'd have two completely different markets operating at the same time, a paper market in free fall as passive funds liquidate positions, and a physical market where buyers are paying massive premiums because they understand the spot price has become disconnected from reality. Have you ever seen a market where the benchmark price and the actual cost of getting the physical commodity diverge by 30-40%? That's not a functioning market. That's a market in the process of breaking down. And this isn't speculation about what might happen in some distant future. This is what the mathematics of the rebalancing almost guarantee will happen starting Thursday, January 9th, unless something changes dramatically in the next few days. Now let's fast forward to what happens after this rebalancing chaos settles. Late January, early February. That's when we hit the next critical test. COMEX has a delivery cycle in February, and here's where the real pressure could build. Historically, only 3 to 5% of silver futures contracts stand for physical delivery. Most traders close out positions before delivery, taking profits or losses in cash and rolling into new contracts. But what if, after watching what happens during the rebalancing, a larger percentage of contract holders decide they want physical metal instead of paper promises? Industry analysts are watching for February delivery requests to potentially hit 12-15% of open interest instead of the normal 3 to 5%. That might not sound like a huge difference, but when you're talking about a market with 800 million ounces in outstanding paper claims and only 31.8 million ounces available for delivery, even a modest increase in delivery requests creates a mathematical crisis. If 12% of contract holders demand physical settlement instead of the historical 3%, you are looking at delivery requests that could exceed available registered inventory by a factor of 3 or 4 to 1. At that point, COMEX faces a choice that no major commodity exchange wants to confront: default on delivery obligations, or invoke force majeure, essentially declaring that extraordinary circumstances make it impossible to fulfill contracts as written. Either option would represent a catastrophic failure of market function and would fundamentally alter how investors view paper-silver contracts going forward. You can't have a futures market where delivery isn't guaranteed. The entire premise falls apart. But let's zoom out from these immediate crisis scenarios and look at where this could take silver prices over the next several months if these stress points play out the way the mathematics suggest they will. Goldman Sachs recently published a $4,900 gold price target for 2026. And while that headline number grabbed attention, the implications for silver are what really matter for anyone positioned in this market. Here's why. During periods of monetary stress and physical metal shortages, the gold to silver ratio tends to compress from its normal elevated levels back toward historical crisis ratios. Right now, gold and silver are trading at roughly a 59.1 ratio, meaning it takes 59 ounces of silver to equal the value of 1 ounce of gold. But during previous crisis periods, particularly the 1980 Hunt Brothers situation and the 2011 commodity boom, that ratio compressed to 40.1 or even lower as silver caught a bid from both monetary demand and supply constraints. If Goldman's $4,900 gold target proves accurate and the ratio compresses to 40.1, you're looking at silver prices around $122 per ounce by the second quarter of 2026. That's not a prediction. That's just arithmetic based on historical market behavior during supply squeezes. Now, before anyone starts calculating retirement portfolios based on $122 silver, let's talk about what has to happen for that scenario to play out. First, the Fed needs to maintain its current trajectory of rate cuts, or at least pause, rather than hiking. Lower interest rates reduce the opportunity cost of holding non-yielding assets like precious metals and tend to weaken the dollar, which makes commodity prices rise in dollar terms. Second, the physical squeeze we're seeing in December needs to intensify rather than resolve through this first quarter delivery cycles. If COMEX finds a way to satisfy delivery demands and rebuild registered inventory, the pressure eases. But if February and March deliveries strain the system further, that's when the ratio compression scenario becomes increasingly likely. There's also a technical analysis perspective that's worth understanding, even if you're not someone who normally pays attention to chart patterns. Silver has spent 40 years forming what technical analysts call a cup and handle pattern, a long-term base around 30 per ounce, followed by the recent breakout above that level. When you measure the depth of that 40-year base and project it upward from the breakout point, you get a theoretical target in the $240 to $250 range. That's the 700% gain that permabulls love to talk about. But here's the thing about measured moves in technical analysis. They rarely happen in a straight line, and they definitely don't happen overnight. The more realistic near-term target to watch is $100 per ounce. That's the psychological level that acts as the first major resistance cluster for 2026. Round numbers matter in markets because they're where traders place orders, where option strike prices concentrate, and where media attention intensifies. According to positioning data from Bank of America and JP Morgan's commodity strategists, institutional players are setting up for a potential test of $100 somewhere between March and May of this year. What would it take to get there? You need the perfect storm we've been describing, the Bloomberg rebalancing creating initial chaos. February delivery demands exceeding COMEX's capacity to fulfill. Physical premiums staying elevated as the paper-physical disconnect becomes undeniable, and industrial buyers continuing to compete for available supply as solar and EV production ramps through the spring. It's a lot of variables that all need to align, but here's what's important to understand. Every single one of those variables is already in motion. This isn't speculation about what could theoretically happen. These are trends that are already unfolding right now. Think about your own financial situation for a moment. If you own silver in any form, ETFs, mining stocks, physical coins, futures contracts, you're about to find out whether you're holding a position in a functioning market or whether you're holding a claim in a system that is about to undergo a fundamental reset. The rebalancing, starting January 9th, isn't just another technical event that comes and goes. It's a stress test that will reveal whether the current market structure, with its massive leverage and shrinking physical inventories, can survive when forced selling meets genuine supply constraints. Here's what we know with certainty. $5 billion in forced selling is hitting a market with $2.3 billion in available physical inventory over the next 5 trading days. Those aren't estimates or projections. Those are the published numbers from Bloomberg Index Services and COMEX warehouse reports. What we don't know is how the market reacts when that imbalance becomes impossible to ignore. Do paper prices crash while physical premiums explode? Do market makers step back and let spreads blow out to unprecedented levels? Do we see the first signs of delivery failures that force COMEX to alter settlement terms? The answers to those questions will determine whether silver spends 2026 consolidating recent gains around current levels, or whether we're at the beginning of a repricing event that takes the metal to levels most analysts considered impossible just 6 months ago. Either way, the next 2 weeks will tell us more about the true state of silver markets than the previous 2 years combined. Because when you force $5 billion in selling into a market that can only deliver $2.3 billion in physical metal, something has to give. The mathematics don't allow for any other outcome. What happens starting Thursday isn't just market volatility. It's the moment when our 40-year experiment with paper precious metals markets either proves it can handle real physical stress or reveals itself as a system that only works when nobody actually demands delivery. And for anyone holding silver right now, or anyone thinking about entering this market, understanding that distinction could be the difference between positioning for the opportunity of a decade or being caught on the wrong side of a market structure failure that reshapes how precious metals trade for the next generation.